Good evening. Most of you are probably home enjoying the 4th of July holiday. This is week 1 of 622, and in week 8 of 621, we talked about costing a product, direct labor, direct materials, and overhead. Financial accounting is concerned with cost functions, and the functions being it's either a product cost, which is what we talked about in week 8, or a period cost, which is not associated with a product and gets expensed in the year that it's incurred. In managerial accounting, internal accountants are more concerned with cost behavior. Because in the short run, decisions might be made which increase profitability, but in order to make these decisions, you have to understand how costs behave. So tonight, week 1 of 622, we're talking about cost, volume, and profit. And depending on how costs interact and decisions are made, it impacts profitability. Okay, now, one of the things we're going to talk about tonight is this concept of break-even. And break-even is a way of analyzing a project from a very high level. And the whole idea is that before we spend a lot of time and effort going into great detail as to whether or not we want to do something, a break-even analysis helps to determine the feasibility of even doing the project. Okay? And break-even is simply where total revenue equals total costs. All right? All right, now another thing, all right, so, and we can also, since we don't intend to operate at a zero profit, we can also add a target profit to this analysis to determine how much sales we need, and then we can play a lot of what-if games by changing the individual components of cost, volume, and profit. Okay. All right, now what we're doing here is we're taking an illustration here where the average monthly cost of operating the airline is $66,000. All right, and what they're trying to do here is separate the $66,000 into fixed costs, variable costs, and what they call semi-variable costs. So a fixed cost is a cost that will be incurred no matter what we do. Okay, and they give some examples. Executive salaries, property taxes, rents, leases, and insurance. In other words, these costs will be incurred whether they fly 1 mile or 100,000 miles. Now, variable costs will change with volume. In other words, at zero volume, variable costs are zero. And then they increase proportionately as the volume of activity increases. Now, semi-variable costs are costs that incur, are costs that are made up of a fixed and a variable component. The best example I have of this is your utility bill, which comprises a fixed charge for being hooked up to the grid, and then as you use electricity, your bill increases. But even if you used 0 kilowatts during the month, you would still pay the fixed portion. Now, their example here is it says McKinley pays to the Fairbanks Airport, they rent hangar space, all right? And then there's an added charge for every passenger mile that's flown, okay? All right, so what they've done here, and again, this is an example, their fixed costs are $11,000 of insurance, $8,000 of depreciation, and $20,000 of salaries. Their variable costs are 8 cents a passenger mile, and the semi-variable costs are $3,000 fixed and 2 cents for every passenger mile. Now, I said that in financial accounting, it's either a product cost or a period cost. And the big deal there is product costs remain on the balance sheet until the product is sold, and then period costs are expensed in the period they're incurred. In managerial accounting, when we look at costs, right now, we are simply looking at costs as to whether they're fixed, variable, or semi-variable, and the concept of product and period cost is ignored. Okay. So this is a nice little graph here, or these a number of graphs. And the first graph shows fixed costs. And the fixed costs are $38,000, and they're going to be incurred whether passengers fly or not. Variable costs are start at 0 and then increase proportionately depending on how many passenger miles are flown. The semi-variable costs start at 3,000 and then grow depending on the passenger miles. Okay, so if they're giving us 3 scenarios here. If they fly 200,000 passenger miles, the total operating costs are $62,000. If they fly 300,000, the total costs are $72,000. And if they do 400,000, the total cost is $82,000. Now, you're never supposed to look at fixed costs as a unit cost, okay? But that cost per passenger mile is an all-in number. And the idea here is that, I should say the reality is that the more we do, the fixed costs are spread over more and more passenger miles. So the more we do, the cost per passenger mile, which includes the fixed cost, actually decreases. And that's because the fixed costs are being spread over more and more passenger miles. Okay, so you can see that, you know, as volume increases, the cost per unit decreases. Okay, so a quick review then is that the unit cost of a variable cost stays the same, where no matter what the volume is, the unit cost stays the same. Fixed costs, however, the unit cost will actually decrease the more you do, and if volume decreases, the fixed cost per unit will increase. Now, if for total costs, if volume increases, costs will increase, and if volume decreases, costs will decrease. Total cost will. Fixed costs, on the other hand, stay the same. Total fixed costs stay the same no matter what. All right, so total variable cost increases with volume, decreases with a decrease in volume. Whereas fixed costs stay the same no matter what you do. Okay. Now we're kind of switching here. We're talking about an auto manufacturer, and they're using this to describe the phenomena that I was talking about, because fixed costs are constant, the more we do with the same amount of fixed cost, the fixed cost per unit does decline. However, if you picked up a cost accounting book or a managerial accounting book, they would caution you not to look at fixed costs as if they were a unit cost. Okay, now, a fixed cost environment, all right, now we're looking at the cost structure of an organization. It tends to be higher with airlines, oil refineries, steel mills, utility companies. What they're getting at here is if you have a high degree of fixed cost in your cost structure, in bad times, it's very difficult to get rid of your fixed costs. You can't lay off an airplane, all right? Whereas if you have a high degree of variable cost in your cost structure, like an accounting firm, when the work slows down or if you lose clients, you simply lay off people, okay? All right. So I don't think it's mentioned in this chapter, but companies with a high degree of fixed costs are considered riskier than companies with a high level of variable cost. All right, this is nice to know. I'm not going to really concern you with it. But what they're getting to, they're saying that in the range, and we're going to learn in a minute, it is called the relevant range. Costs tend to behave normally, but when you get to the bottom or the top, that's when costs begin to vary a little bit more. But we're going to learn at the end of the lecture that one of the assumptions in cost, volume, profit analysis is that your unit variable costs remain constant, you don't produce for inventory, fixed costs remain constant, and the sales level is constant. Okay. All right, now one of the things that having a high degree of fixed cost in your cost structure does is that for given levels of, in other words, if you had a small change in revenue will produce a high change in income for companies with a high degree of fixed cost in their cost structure. All right, on this slide, it shows the concept of the relevant range. And the relevant range is the normal output of an organization. Now, it can fluctuate. Normal is a relative term, but we're saying relevant range is the normal operating activity of an organization. Okay, now, when we talk about cost, volume, profit, we're talking about operating income. So going back to your financial accounting, We're not talking about taxes, interest expense, other income and dividends. We're simply talking about the income generated from the activity that the organization is in business to do. Okay, and again, break even is where total cost equals total revenue. All right. All right. Now this goes to what I said. Other operating, other income and expense, interest, taxes are ignored. All right. Let's see. All right. Now it says assume that Snowblind Company manufactures entry-level snowboards. The company currently sells its product to wholesale distributors in Colorado, Washington, and Oregon. Because of the popularity of snowboarding, the company is considering distributing to several East Coast wholesalers as well. Although wholesale prices vary depending on the quantity of boards purchased by a distributor, revenue consistently averages around $90 a board. Okay, now so the unit selling price is $90. The variable costs are $36. So the contribution margin, now this is a term we haven't heard until tonight. The contribution margin is the difference between your variable cost and your selling price. Now, in the Go Live problem that you're going to have to do, that will be due a week from Wednesday, the trick is that you're given total production, and you're given the total production assumed, and you're given total fixed cost, or you have to calculate the total fixed cost. If you divide total production into total fixed cost, you get a fixed cost per unit. All right. Now, the idea behind which is your contribution margin. All right. So to get your selling price, then to give you a certain contribution margin, you just add your variable cost. All right. Now, the reason it's called contribution margin is because this value, this contribution margin, is left to cover your fixed costs. All right. Now, there's two ways to do break even. One is using contribution margin, and the other is using the contribution margin ratio, which is simply dividing the $54 of contribution margin by the $90 of selling price, resulting in a 60% contribution margin ratio. All right, and then for the snowboard outfit, they list the fixed cost, which totaled $37,800. Okay, now this is a graph that shows the various points, and the one being the break-even point. Now, the way you calculate that break-even number of $63,000 in revenue, or 700 units, you have your $90 selling price, $36 variable cost, and a contribution margin of $54 a unit. You take that $54 a unit and you divide it into the total fixed cost. And that's how they ended up with the $700 of units necessary to simply break even. Okay? And again, going back, that dotted line, the break-even point is 700 units and $63,000 worth of revenue. And the $63,000 worth of revenue is the fixed cost divided by the contribution margin ratio. So it'd be 37,800 divided by 60%. Okay, now, since we don't operate a business to break even, we can plug in a target operating profit. Now here they've said, well, how many units do we need to sell in order to make $5,400 worth of income, operating income? And you simply treat that operating income as an additional fixed cost. So you take your fixed cost of $37,800 plus the target operating income of $5,400, divide by the $54, which is your contribution margin, and in order to get $5,400 worth of income, you need to produce and sell 800 units. Okay. All right, now, again, if you wanted to calculate the revenue you need to get the $5,400 of revenue, you would take your fixed cost of $37,800, the $5,400 operating income, and divide it by the contribution margin ratio, and you end up with, you need revenue of $72,000 to generate a profit of $5,400. Okay. Okay, now, new concept, margin of safety. Okay? The margin of safety is the difference between your forecasted revenue and your break-even revenue. Okay? And it's calculated as a percentage. Well, all right, it can be a percentage or it can be an absolute number. Now, here they're saying, well, if your monthly sales were $73,000 and your break-even sales were $63,000, then your margin of safety would be $10,000. Okay. All right. Now it says the margin of safety can provide a quick means of estimating operating income at any projected sales level. This relationship is summarized as follows. It's simply operating income equals your margin of safety times your contribution margin ratio. Okay. All right, now what they're saying here is, you know, accountants can use cost, volume, profit, but cost, volume, profit could be used by anybody. All right, let's say, for instance, you wanted to start a business, and usually sole proprietors go into a service type of business. Now, in a service industry, what you're really selling is hours of work. And you've probably never looked at this, looked at life this way, but if you work 8 hours a day, 5 days a week for 52 weeks, that's 2,080 hours. All right? So you choose a number that you need to live on as an annual income. But then you have to gross it up for the your taxes that you're going to pay. All right, so your after tax or your before tax income, and then because you're familiar with this business that you're about to enter, you know the variable cost and the fixed cost that you'll need to spend. Anyway, you're backing into a level of revenue that you need to generate this after-tax income that you want to live on. And if you divide that number by 2,080 hours, you get your billable cost or billable revenue per hour. And if it turns out to be $500 an hour and the going rate for what you want to do is $200 an hour, well then you know you got to go back to the drawing board. But again, you don't have to hire a consultant. You don't have to invest in very complicated software. Again, cost, volume, profit is a way to look at running a business from a very high level and making decisions. All right, now here's cost, volume, profit. Cost, volume, profit. Once we get our break-even set, then we can tend to tweak the numbers. So it says assume Snowglide is currently selling approximately 900 snowboards each month. In response to new marketing strategy, if they increase advertising by $1,500, all right, says in response to a new market strategy, the company's director of advertising is asking for an increase of $1,500 in advertising. From her experience, she's confident that the advertisements will result in monthly orders from the East Coast distributors to 500 boards. All right, now she wants to know if the increase in advertising and the resulting increase in sales is going to be worth it. All right, so it says we begin by calculating the current monthly income of 900 boards, and then we're going to tweak it to say, well, what happens if we increase expenses by 1,500 and sales by 500? All right. So before we make changes, our current income is 10,800. All right. Now, what they're saying here is that the contribution margin is 60%. So if the contribution margin is 60%, then the variable costs have to be 40. All right, and then the fixed costs are the fixed costs. Okay, so it says, as the proposed advertising is viewed as a fixed cost, this expenditure does not affect the contribution margin, all right, of 60%. So based on the projected monthly sales of 126,000, 1,400 times $90, the projected monthly operating income can be determined as follows. Fixed costs plus the unknown number here divided by the contribution margin. So we've increased the fixed cost to 39.3. That's the 37.8 plus the 1,500. And now what we're solving for is the projected operating income. All right, and this is more algebra than anything else, the projected operating income results in 36,300. All right, so if just looking at this, to stay the way we are, the projected operating income is 10,800. If we move to the East Coast and increase our sales, but also have to increase our advertising, we actually have a reduction of 36,000 down to 36,300. All right. So the target income figure is 25,500, higher than the present monthly figure of 10,008. I don't know where they're getting this. All right. I don't think that paragraph agrees with the results here. Okay. Oh, I misread. The projected operating income is 36,300. All right. All right. I was wrong. I read it wrong. So there's actually going to be an increase of 25,500. In other words, we're going to go up from 10,800 to 36,300. All right. So spending the additional $1,500 then is worth it. I apologize for my mistake. All right, Snowblind's manager does not completely agree with the advertising director's projections. He believes the increased demand for the company's product will initially put pressure on the plant's production capabilities. To cope with the pressure, he asserts that many manufacturing workers will require an increase in labor. So assuming that he's correct, he wants to know the sales volume and units required to achieve the advertising director's projected monthly figures of 36,300. All right. So now we have to change and this is what cost volume profit does. Now we're going to tweak variable cost. Instead of $36 a unit, we're going to say it's going to be $37.80. All right. And now they're getting the 36.3 from this slide here. So we change the target operating income, or excuse me, we leave that the same. We leave the fixed cost the same, which includes the $1,500 of advertising, and we divide by the new contribution margin. So by tweaking the variable cost, now we need to sell $14.48 in order to meet the target operating income. So now, and you're saying, well, aren't we just playing with numbers? Well, the question then is, do we have the capacity and the ability to make 1,448 units a month? Is that within the realm of possibility? Okay. Well, I hope you all enjoy your fourth. Again, the goal line problem, and I hinted earlier in the lecture how you would go about it, and you know, once you determine, once you figure that out, the problem is relatively simple to solve. Okay, I'll see everybody on the 10th. Okay.